Ladies and gentlemen of the crypto space, we're live on a Friday at 11:29 a.m., February 12th, the end of the week, and the data is just pouring in. Let me just preface the start of the video that I adjusted frame rate today. Keep me posted if there's any lag, and I try and optimize it, but obviously the audio comes through, so I don't have the best AV audio video equipment. It is what it is, and the content is what counts. Who's in the stream? Just a little prep check. Lights in the house. Mark McNeil, always a pleasure. Charlie G, my man, the one rook winner, the brain, Stelios, Squanchy. Yes, indeed. Today's topic: permissioned China, permissionless US. We have big stories in play. And we all look at the same data. We all look at these assets that have price and they're going up. And we really need to understand why and what these markets are. And that's why we really look at the macro data. We look at the long end and the short end of the curve. I obviously generalize it for presentation purposes. But generally, looking at the 30-year and the 2-year gives us a good sense of the steepness of the yield curve. Definitely got to keep an eye on the dollar and the changes we've seen in the dynamics with the dollar as the yield curve has steepened with regard to the dollar being muted in the way it has triggered depreciative effects in the broad asset space is quite fascinating. And these are things we see in the data and are these ideas, these observations of how markets behave are validation of these theories and these hypotheses of how we relate the data to what's actually occurring in the markets. And that's the whole point. We take the data, we aggregate the data, we identify confluence, which are multiple points of interest that support or either discredit a hypothesis, and then we test the validity of hypothesis. Either we have a validation or invalidation of trends, or with regard to chart data, price data, or hypotheses about how markets are going to behave, and that's a good part of something we're going to talk about today. I obviously digress. That's just the way my brain works. So let's get into it. Today's episode is sponsored by Change Angel, the non-custodial swap exchange for social goods. Stop depositing on exchanges, not your keys, not your crypto, non-custodial DeFi, or nothing at all. Let's pop it over to the main screen and see what's going on. See you, Zels. Who else did I miss? Captain Weber's my man. You said you were going out on the boat. Always a pleasure. Always. Major in the house. First time streaming. Rooking. We're rooking. I got the rook chart up. And you guys know it's a big part of the narrative. Very big, grandiose narrative. There's no competition for this particular product in the space. Always remember, price action is completely mutually exclusive from the awesomeness of an asset, which is a common theme I always talk about when referring to the best UTXO asset in all regards, technologically speaking, which is Digibyte, which, I've looked at the charts. I posted a couple of charts on Twitter. Because of how inflated the markets are, relatively speaking, because I'm looking at NASDAQ and comparing it to Bitcoin, Digibyte has further to go. It's likely going to be somewhere around the price point of all-time high, like 10, 11, 12, 13, 14 cents before we start to have bullish confluence in the chart data. And that's what matters. You got to wait for bullish confluence, folks. And it's, that's quite a counterintuitive approach, waiting for an asset to go up 100% before taking a position. But to me, it's proven effective, and confluence is extraordinarily meaningful in having a high confidence that an asset will continue the price appreciation that you want it to. That's why we wait for confluence. If you have a breakdown and invalidation of a trend, you don't want to sit through a depreciative cycle. And that's the whole point. That's why we look at the data. We take actions based on data, data driven in programming software. We call it data-driven development. We capture analytics and we change the user interface, do A/B testing and whatnot based on actual data, and that's all that matters. Who else is in the stream? We got Crypto Chick in the house. Bid is in the house. Always a pleasure. Officially bidding now. Yes. I like grass-fed beef. I do too. It's so weird. Me and the wife were talking about that the other night. She literally had like a 10-minute conversation with me about grass-fed beef. Um, my man, Squanchy, what are you saying about DGB? Makes a lot of sense. Yeah, I love Digibyte. I wrote the Digibyte wallet for Android. I just, from a financial perspective, we have to respect our portfolios, follow rules, allocate proper position sizes, have appropriate balance with regard to risk on, risk off assets, seek out aggressively yield bearing assets, because in the end, one of the biggest counterintuitive ideas is that you buy an asset because you love it. So many persons buy Digibyte and love the shit out of it. They think it's going to change the world. And in many regards, I'm with that. I think it has an extraordinary potential place in the future of many industries, as I describe its narrative to be, pretty much the only UTXO blockchain that's suitable for business record storage and asset management. But you're going to wait for it to go up in price to like $1, $2, $3, $4 to sell it. You're going to sell the asset that you loved so much. So that's not the way to treat these assets. What you're always doing, you have to think from the portfolio perspective. What you're always doing is you're perfecting the portfolio balance. As an asset appreciates, you want it to be less of your portfolio. So you're adjusting the portfolio dynamically as each asset has very individual behaviors. And interestingly enough, this is probably the most counterintuitive thought of them all. If you expect an asset to asymmetrically appreciate more, you actually want that to be less of your portfolio. The perfect example I've been going to, because Alpha was released in November, it has a lot of potential. It's a serious protocol, DeFi protocol, but it went up 5,000 to 6,000%. If you put $300 into it, you turn that into 15 grand. So when an asset is going to likely, or you expect it to, you're hypothesizing it'll appreciate asymmetrically, it should be the smaller portion of your portfolio, with the vast majority of your portfolio allocated to risk off, yield bearing assets. And as we know, and as we've talked about quite a bit of streams ago at this point, is the craziness that you could do in the DeFi space. I mean, you could literally have like a bunch of Bitcoin that's sitting and doing nothing, or you could collateralize it into a debt position on MakerDAO, extract 30% of it, and apply it to basically de-risked, as I would argue, assets that are producing enormous yield. Let's say you put it into 1 inch and an Ethereum, you can get 100% APR returns, not APY. It's not compounded unless you do it manually, but APR returns, which is extraordinary. And then I also posted on Twitter that people hesitate to do it because they think it's unsustainable. But that's the point. It's not a sustainable yield. As more liquidity enters the space to meet supply and demand, to meet the demand on the asset to be borrowed or exchanged, the yield will go down. So this is an extraordinary time. It's an under liquid state, the system. It will Liquidity will increase, the yields will normalize, but most importantly, what is real is that the demand, the monetary velocity, is increasing just at an enormous rate. And this is why we look at like USM2 money supply and the monetary velocity, which looks like it's in the process of being decommissioned as compared to the monetary velocity of the DeFi space. Basically, monetary velocity is a self-fulfilling prophecy. It is a self-sustaining system that's going to draw in more and more participants, because the legacy financial system is completely absent of yield-bearing products, and people are always in the search for yield and new technology and more efficiency and the next step, the evolution. And when you look for applying value, you're looking for markets that are outperforming, and you're exiting markets that are underperforming. And that's why I look at this chart, boys and girls. This is the most incredible chart. I don't even look at Bitcoin USD anymore. I don't care about the USD price. Bitcoin is outperforming the S&P 500, and the last tower of defense the legacy financial system has is NASDAQ. Once Bitcoin breaks out against Nasdaq. So this is basically Bitcoin versus Nasdaq. The quants, the people that look at data just like I do, on Wall Street will see it. Their data will show it that Bitcoin is now the outperforming asset, which will lead them ultimately to the broad crypto space, which means Bitcoin is going to asymmetrically appreciate, and the broader alt space is going to produce exponentially larger asymmetric appreciation. Whole another story, craziness. I try and put it all together, try and paint a picture for you guys. Let me see what I'm missing. Video check right now. YouTube says it's spinning. It's spinning. So let me know if you haven't seen any issues on your guys' end. Major says my pops Gunny Murphy in the house. Yes. Bancor has been 100 to 300 single side staking. Early adopters getting the cake. I mean, come on. The Bancor is a ridiculous protocol. It's extraordinarily undervalued from an asset price perspective. I'm not too worried, but if it's not significantly appreciating, you only apply a small position to it. What's interesting is I think that Kyber and Bancor are on cyclical bottoms, very cyclical assets, and the correlation between Bancor and Kyber is extraordinary, absolutely extraordinary. So we're not. I don't want to delve too deep into that. I want to keep the topics broad today. Um, Zatar's in the house. Captain Weber, what are you trying to tell me? Can I sell my incredible crypto assets? No, I'm telling you when you're ready, won't have to sell. That straight up matrix right there, boys and girls. Isn't that the name of the game? Um, you're not going to have to sell most of these assets. So your task, your what you need to do is identify the assets that have been effectively de-risked. And I will argue at this point that assets that contribute to crypto monetary velocity have been effectively de-risked and are going to draw in increasing more and more participation and liquidity. And it's basically building the foundation of the subsequent financial system because of the opportunity that's available. I mean, literally, you could borrow and lend assets. This disrupts banking. Anyone could lend an asset, whereas with a bank, you give them your liquidity and you get nothing for it. So the banks are lending your money for mortgages and other strategic financial opportunities, and you get absolutely nothing for it, which is absolutely ridiculous. What a tragedy! But I mean, literally, Aave just launched a fiat on ramp. um, it's extraordinary what's playing out, and it's hard to surmise in a couple of sentences in the mere 30 minutes we share on a daily basis what is actually playing out. Let me just make sure that missing nothing in the stream. Take both pills. That's right. Not red pill. I'm red pilled and blue pilled. So I have my own stories. I live in my own little world, but I also see what's going on in the real world. So dab on both pills. Noah, for 89% yield on sushi, do you stake it or provide liquidity? It's both. You provide liquidity and you're staking. So you're getting yield from the transaction fees, and you're also getting yield denominated in sushi, where they allocate some of the inflation to incentivize participation. Now, the reason that works is quite fascinating. Even though it's an inflationary asset, by having the staking and the pools, which encourage supply disruption, people are taking supply out of the market. They're not trading it, but they're giving it to the AMMs to facilitate liquidity. Um, it results pretty much in a net deflationary effect on the asset, and that's extraordinary. And that's what's occurring. That's what has proven to be the case since 2020. This is why these protocols, and this is why Curve got dumped down to 20 cents, is now $3, because the deflationary effect kicked over and assets were taken out of circulation, more assets than the inflation of the supply. And that cycle is recursive. It's self-reinforcing, and in a couple of years we'll see how this all plays out. But what I know is that one, the monetary velocity is going to continue to sustain exactly what's occurring and grow it, and it's going to expand and evolve. And I also know that the persons that are crafting and creating these protocols have extraordinary game theory capabilities. These are some of the smartest people on the planet, producing some of the most sophisticated software on the planet. And and that is something to allocate value to. Um, we'll see how things evolve. We follow the data, we look for story changes, we adjust our portfolio to respect story changes. That's the name of the game. Reserve name bear finding that stuff fascinating. Yeah, so I do sushi, I do 1 inch, and I do curve at this point. I got a little bit in Bangkok, but that's it. I you know, generally speaking, curve 1 inch, um, Uniswap, um, uh, all of them. Who did what? I gave a list. Curve 1 inch sushi, Ave, Uni, Ren, Zero X, which is 0x. Bancor and Kyber are not entirely de-risked at this point because they just don't have the monetary velocity going on. But I think they're really getting close to critical mass. And you just keep an eye on the data. Watch the data. With regard to taking a position in those assets. Wait for them to get over the long term moving averages on like the daily or the weekly chart, which is exactly the same thing I'm telling everyone about Digibyte. Wait for that bullish confluence, which is the break to the upside, the retest, and the higher high, and that is quite reasonable. Favorite curve pools? Yeah, the GUSD pool is off the charts, cranking out 100% APR. I also like the compound pool, the first pool on the list, particularly because it's just DAI and USDC, which doesn't involve Tether. Not that I'm really fearful about Tether at all at this point. To me, my assessment of what they're doing is basically euro dollars. And there's like what a little over $1 trillion dollars in circulation, like M1 based money, and I'm sorry, and from derivatives and all the fancy shit, there's like a quadrillion, but there's something like a couple of quadrillion euro dollars in the system, and they just literally make this shit out of thin air. When you borrow from a bank, uh, uh, um, you have oh my god, uh, George Gammon tells the story much better. You have debts and liabilities and assets, liabilities and assets, and it basically creates money. That's just the best way to think about it. So without banks, with the M2 velocity imploding, it's basically destruction of not dollar bills, but the more important aspect of an economy, the actual money, and that is the significance really of monetary velocity, at least that I see it, and as I'm able to surmise it in a couple of sentences. You got the broad M2 monetary velocity of the United States currency, U.S. fiat, looking like it's being decommissioned compared to absolutely vertical. Exponentially increasing velocity in the DeFi space at this point. Captain Weber wants to talk about Cosmos. Yeah, the original topic for today was China versus the US. So China is a permission system. They're a nationally permission system. They're a communist country that has democratic tendencies. They love the financials of democratic processes, but they love the control, security, and all that fancy jazz that comes along with totalitarianism. So Cosmos is part of that story. Cosmos has been chosen as a core component of the BSN. The BSN is the Chinese national blockchain project. China is significantly further advanced than the United States with regard to a national blockchain policy. China is deploying blockchain technology across its country at a pace that makes all other countries on the planet seem that they're not doing anything. They are all in on cryptocurrency. They're going to be driving it into business and driving it right through their central bank, right through the digital yuan, across the permissionless blockchains, and I think in good part, all of that's going to funnel through Cosmos vis-a-vis IrisNet and IRITA. IrisNet facilitates the interoperability across the entire Cosmos blockchain of blockchains, and obviously the BSN will facilitate interop across other networks as well. I mean, literally, just look up the BSN and you'll see they have every major blockchain in there. The BSN is tying it all together, throwing it in a pot, stirring it up, baking a cake, and handing it on a silver platter to its citizens to reinvent an entire financial system. Um, so, how does the rest of the world combat what is coming from China? let me first conclude a bit about China. China is putting extraordinary pressure on the rest of the world, whether the rest of the world knows it or not. China funneling its central bank through a digital currency has a capacity to extend unlimited credit anywhere around the world instantaneously in digital form. You need $1 billion in South Africa. You need $1 billion in Argentina where the currency's collapsing. Fire up an Android or iOS cell phone, be registered or whatever policies are going to be required for to interact with the digital yuan, and you'll probably get credit because from a central bank perspective, there's no limits, no restrictions. They will craft their policy. They will create their monetary system anew, and it's digital, so they could iterate at warp speed. And that's what the rest of the world is facing. There is no means of competing with unlimited central bank digital currency. So the rest of the world is negligent at this point, and China is far ahead, and it is definitely threatening to the stability of global sovereign powers, or at least a threat to the status quo balance of powers. So, what I likely think is going to emerge from a U.S. perspective is what has happened throughout history. The U.S. has always relied heavily on the public sector and democratic processes, so on and so forth. And I think we're going to see full-on adoption of public blockchains, and we'll likely at some point see government parties, state, local authorities, and maybe even at the national level get involved with mining. And mining wars are possible. Throw a couple of $1 billion into Bitcoin mining at a national level, but Ethereum as well. I mean, just the technology is profound. And how are they? Look, the mayor of Miami's in on Bitcoin. But what happens when he finds out that instead of the banks, where the mayor's citizens are getting shafted, he could have regulation that either allows or maybe or facilitates corporations to throw money into Aave, or depending on the risk tolerance of the person with value, to other protocols, lending protocols. So the bank, all they do is lend. These protocols, all they do is lend. They do the exact same thing. And that is why, in my mind, I feel at least the monetary network protocols of the DeFi space have been effectively de-risked. They're going to draw in participants. They're all too lucrative. The monetary velocity is basically vertical. Um, yeah, so the U.S. Open, permissionless, decentralized. Tom Emmer talks about it quite well. Brian Brooks laid the foundation, with his banking regulation overhaul, and we're seeing it at the state level. We're seeing banking licenses thrown around, and Brian Brooks's was it whatever the national bank license, whatever he titled it, banking charters. So the puzzle pieces are there. So what I see, just as I started the stream, is data. More data produces confluence. Confluence gives you confidence in saying a potential outcome is more likely or less likely. So gut instinct, we're heading in this direction that I am trying to tell everyone in story form. Some serious shit is on the horizon. That's why we look at the dollar. Wow. Holy crap, boys and girls. Wow. So okay. So ES is basically like dormant. It's like sleeping. I don't know what the hell it's doing. This is basically a good representation of was S&P 500 futures. And we also look at Nasdaq, but I prefer looking at Nasdaq relative to using it to denominate Bitcoin price. But what's interesting was this morning the dollar was absolutely tearing it up, bouncing off the 50 SMA on the daily, ripping it to the upside, slamming into falling wedge resistance. Extraordinary. And obviously, it's completely oversold on the Stoke. Midfield on the RSI. Who the heck knows what's going on with the MACD? But it looks bullish coming off a lower low back in the day. And was that the 17th October, late last year? So while this thing was ripping up, ES was flat. It's not like it's a red dip. So here's the kicker. Historically, when the dollar would tear it up vertically, we saw a complete devastation in the broad asset space. But what's happening is the yield curve has steepened. So the long end of the curve, rates have risen significantly. A lot of folks, a lot of gold bugs have been taking note. But what I just noticed is that it's sitting on the 100 SMA on the weekly. And there's upward pressure because, as you can see, this wick down and it was below the 100 SMA, but now it's clearly in a dragonfly doji formation. This thing, I'm inclined to think, based on some other international data, hedge eye data and whatnot, that we're in a reflation narrative, especially with the CPI coming in at what, three and change. At least that was the speculation I saw floating around on social media. We're looking at inflation, and whether there's as Raul talks about structural inflation or not, because dollar demand globally, how the hell are they going to supply all those dollars and distribute it past the banks in other countries? That's a whole complicated story that Raul tells very well. Aside from structural inflation, we're actually seeing broad spectrum asset price inflation. And the short end of the curve, I'm not going to pull it up, it takes too long, but I think it's being distorted as banks are front running the shit out of stimmy that's coming. That's my general opinion based on what makes logical sense to my mind and the data that I'm seeing and the political policies that are playing out in our system. What am I missing? Igor made this dollar dip. Came in intermediately after stimulus news. Unknown. I haven't been looking at headlines. I mean, it's always the news like, oh, we're gonna have stimulus. The stock market's up. Stelios wants to see TA and Rook. So Rook was ripping this morning, serious breakout into the low mid 700s, extraordinary price action. Look at these two candle bodies over yesterday and today, absolutely incredible. So um, broadly in an ascending triangle. Ascending triangles are basically a process of shaking out old position holders, cycling in new position holders until it's no longer profitable to sell. People that hold the asset from time ago have either adjusted their positions or they're no longer interested in selling because they want to hold it. And that means the persons that have entered at this price range have to sell it at a higher price point to even consider liquidation. Otherwise, it's not profitable or a loss. And that's basically the psychology that plays out with an ascending triangle formation. Every time you see a wick up and it wick back down, is an old holder seeing an opportunity to extract some value. But let's say someone had 1,000 and now they're down to 250. Now their psychology and analysis of the market changes. They love their Rook. They see the future of it, and they're like, I'm not going to sell. I have enough. I have a position size that is appropriate for my risk tolerance. I want to wait for this to appreciate, and I don't want to take the profit right now. And that is exactly what will play out. And that is why in ascending triangles, you see the higher low formation and basically the flat ceiling. The flat ceiling is a psychological barrier that's self-reinforcing. As a ceiling starts to form, it just reinforces itself until it finally cracks to the upside when a full cost basis reset has occurred. WSS in the house, Rook Discord present. I love that channel. You guys are fun. And what's really nice is that, I think you guys appreciate what I say, and I hope it helps make proper or better decisions, which ultimately, as I always say, is for yourself, your friends, and your family. We got to make good decisions. We got to turn Main Street into the smart money, because shit, at this point, it's my reasonable conclusion that there's a lot of dumb money playing in the stock market. I mean, I know there's like really smart quants and PhDs, and I just don't understand why they're trying to extract value from the extraordinarily overinflated equities markets. What a waste of time. Just it, I don't understand why they're not the smart money and applying value to the underinflated everything else. And we see exactly what's playing out, particularly when we look at like the S&P 500 versus Bitcoin. Bitcoin is outperforming the broad S&P 500, and we see basically this: how are quants just now like jumping ship? This chart, either Nasdaq takes a dip or Bitcoin breaks out, and then this chart will be empirical evidence that Bitcoin is outperforming the broad Nasdaq equity space. And what does that mean? When you're a hedge fund and so on, and money, big money, and pensions and so on and so forth, family offices, you're applying value, you're redistributing value from underperforming assets to overperforming assets, following the trend until the story changes. Because that's what I do. That's what they're going to do. Uh, the trend continues until it stops and reverses. Underinflated assets are going to extract value from overinflated assets until that particular trend reverses. And what is basically that trend reversal? It's basically a mean regression from both ends of the spectrum. Overinflated, median line, underinflated. So what you're going to have is something like this. It's a normalization process that's found in nature. It's basically, biologically you could define it as homeostasis. And the system right now is distorted beyond belief. And that normalization process I define as the great value reallocation. It's going to be the most epic value reallocation we've probably seen in the last 100 years. You're going to have an enormous amount of value applied to commodities and mining. And the foreshadow that I see in the data is my mining portfolio, 6, 7, 800%, 1,000%, and it's just starting. You're talking about the mining sector and commodities at post World War II lows. Linaldo will talk best about how to compare the current state of commodities and mining potentially to their historic valuations. You can show some great data over and over again. So that normalization process, as the value flows from overinflated assets to underinflated assets, is going to be awe-inspiring. It's going to be probably fast at some points, especially if there's a massive span wedge correction in the broad equity space. And it's going to be slow and steady at other points in time. I expect this to probably be about a 10-year process. Mining is going to take about 10 years to play out, and the electrification with regard to the energy systems, the energy sector. It's not just cars. By 2030, according to Simon Moores and other extraordinary persons that have aggregated the data and done the analysis, cars will be 2% of battery requirements when you're talking about electric grids and corporate storage facilities and other large-scale battery storage needs to stabilize the currently extraordinarily fragile electric grid system. Best mining pick. Yeah, I would have had a couple last week, but some of them have moved significantly. I mean, some of them are up like 400% since last week. One that is undervalued that I think, look into Pilbara Minerals. I mean, there's a lot. I don't know what's playing out with Australian mines in Australia. You're talking about a lot of Australian companies. There's barely anything in the U.S. It's barely anything. It's all these players are incorporated in Canada and Australia. But those are the two picks, at least to look into. And bear in mind, there's not crypto space. This shit will take 10 years to play out. And I've been holding some of these stocks since like 2016. And now is when I'm starting to see the hypothesis play out. It's 4 years. Years. So imagine sitting on something for years. But in the end, now I always thought I was right, but now I have empirical evidence that my hypothesis was correct. And I was the early money. I was a smart money in those particular assets, sitting on 4, 5, 6, 7, 800, 1,000, 1,200% gains in some of these assets. They were small positions, but the small positions turn into big positions when you're talking about 20, 30, 40, 50,000% gains over the course of 10 years. And that's what's going to play out for the broad commodities, mining, metals, and crypto space as the greatest value reallocation in history takes place from overinflated assets to not inflated assets. And this is the perfect chart. This is the perfect chart. Look at this. If you go back, let me show you guys this. You're going to love this. Let me pop this over to the weekly. So this is 2017 back here. Bitcoin is just breaking out. Folks think, what, 20K, all-time high? Who cares about the dollar value? Stop looking at the dollar value. What you care about is the inflated assets, because that's where the value is going to come from to inflate currently not inflated assets. This is the chart that matters. It's broken out against the S&P 500. The amount of value that's going to be sucked out of the broad tech equity space is going to be enormous. How many trillions of dollars are just sitting in there? So once this thing starts to outperform, it just broke out. That's the most exciting thing this week. It literally this week, and you know you have a wick back here. You have a wick of a breakout above the 2017 high last month. But this is just going on right now. So folks are worried about depreciating dollar valuations. This is the chart to understand and look at. Bitcoin just broke out this week. It's all just starting. That is what the data tells me. All right, let me see what folks are saying, and I'm going to wrap this thing up. Man, the dollar dip came immediately after the stimulus news. Yep, we talked about that bad boy. Rook Discord present. All right, Bert, get him blasted. Let's see what it's doing. I mean, it's a great chart. Don't worry about this. Just have appropriate position sizing, and WSS mentioned strong hands. You know, if it dips, it dips. You know, stuff like this only needs to be like 5-10% of your portfolio, and if it goes 1,000%, 5,000%, whatever the heck it goes, that's all good. And the best part is if you focus on appropriate portfolio management rather than the price action, you're just along for the ride with the price. If it goes up, it goes up. But you're part of a technology that's extraordinary, and that's meaningful. And that's the way you really should look at it, not like 50%, 100% into a high risk asset because you're jeopardizing the portfolio. You want to love your portfolio and extraordinarily appreciate remarkable, incredible assets that fit into the crypto space in an absolutely necessary way. The story for this asset is extraordinary. Just don't apply excess risk because then you'll be able to sleep at night. And knowing that if it goes down, it goes down. If it goes up, woohoo! You see what I'm saying there, boys and girls? Can you explain what you mean by banks front running the short end of the curve? Yeah, so a reflation narrative will show rising rates on the short end and the long end. So we've seen extraordinary, very meaningful rises in interest rates on the 30-year, the long end of the curve. So we're not seeing that on the short end of the curve. So here, let me show you guys. It's interesting. Stephen Van Meter is the perfect contrarian thinker to counter my analysis and my hypothesis. So banks need short duration treasuries to account for deposits. You know, $500 million enters the banking system. They need treasuries to basically pay interest on the deposits. So that's the way the banking system generally works. So in a reflation narrative, the short end of the curve would be going up as well, along with the long end of the curve. My speculation is this thing is pinned on support because banks are front running stimulus. If everyone's getting money, a lot of it's going to go to the banks, and the banks know this because everyone got money last year, and they all know how much deposits they got last year. So my speculation is the banks know what's coming. They know they're going to need a huge amount of short duration treasuries to account for the massive influx of capital from stimulus deposits. And that's why I hypothesize that the reflation narrative is playing out. The short end of the curve is effectively distorted as banks front run stimmy. Hashtag stimmy. White Wolf, always good news. All right, let's keep this party rolling. It's just Friday. We're back on Monday. Enjoy Monday. It's a holiday. I'm gonna try and do Monday. Obviously, I'll be on Twitter. If I do Monday, I'll post. Everyone will know. But otherwise, we're back to normal on Tuesday. So enjoy your weekend. Be safe. Be smart. Think about what I talk about. Respect your portfolio. Love certain assets. But watch the weekly portfolio performance. It doesn't matter really the daily. It's the weekly that's important. Risk on, risk off, and respect your hard-earned money. That's the whole point. I'll always say that. Friday, 12:08 p.m., February 12th. As always, we got 39 people in the stream, 23 likes. We can do better. Please tell everyone to subscribe. Wish you all a wonderful day. Y'all have a good one now. Peace.